Seema, what does this mean? The fact that the ECB, they're prepared to get a little bit more hawkish. For them, it seems really hawkish, but nothing compared to the bigger central banks.
Hi, Matt. Yeah, I think that's key, is even if the ECB is becoming a little bit more hawkish, and we're going to see rate hikes this year potentially, that would still leave them so significantly behind the US. But in terms of your relative trades, in terms of your currency perspectives, it doesn't change too much. But I do think the key thing is it does introduce a fair amount of volatility at a time that I don't think Europe can really afford it.
Okay, good morning to you, Seema. If I look at the GMM function on the Bloomberg terminal, I can see that the French 2-year yield is higher, the German 2-year yield, the Italian 5-year yield. It does seem the short end of the curve is responding to this kind of commentary coming through from the ECB. How quickly do we see these yields move higher then, do you think?
I think it could be quite rapid, but really it depends on how far we're likely to see them. And I think, well, the comments that we've seen from the ECB officials in the last few days are really, really important, because we have to think that they, just like the Fed, will be aware of how much volatility they're going to introduce into the market with these comments. So these will have been well thought out, and I think they're giving us a very clear signal. But at the same time, are we really going to see rates move significantly higher? So a 50 basis point move in the next 6 or 7 months or so isn't going to move yields too far, considering they've already moved significantly in the last few weeks.
How much do we really listen to central bankers, in the best sense of the word, on this subject when there is so much uncertainty about how the Eurozone economy performs, and in particular with geopolitical questions and political questions hanging over the Eurozone economy around the possibility of embargoes of more energy products, and there's nothing certain about that. But if we saw that, the Eurozone economic story would change so substantially that things would be very different for central banks.
And I think that's absolutely key. I know from my perspective, I've been very much of the idea that the ECB is unlikely to hike this year, given the deteriorating economic outlook. And as you said, it's risk. We don't know what's going to happen over the next 6 months. But I do think that the ECB officials, some of the commentary in the last few days, have been so clear and indicating that actually they need to put the real economy behind them when they're thinking about normalization. And that is a very clear signal.
All right, Seema, so where does that leave Europe relative to other markets like the US for you?
Yeah, still for us, the US is the clear outperformer from here, from an equity market perspective. We know that the US is less vulnerable to this geopolitical conflict than Europe is. We know that the risk outlook for Europe is that much greater. And actually, we can see a potential recession in Europe just this year, whereas for the US, it's a little bit further out. So from that perspective, it doesn't change too much.
But the US, of course, Seema, also is heavily weighted toward technology. To be positive on the US, do you also have to be a little bit more optimistic on some of those growth names?
I think that is important. And certainly from our perspective, we do think this is still the time to have a slight overweight to some of these tech firms. But importantly, it's a mega cap tech. You have to differentiate at this stage. It's not really about the non-profit ones, which I think will struggle in this kind of environment. For the mega cap tech, yes, rising bond yields, high bond yields are something of a challenge. But we also think that bond yields are quite close to the topping out. We've been talking about in the market most recently about inflation likely to have peaked. So from there on, I think the situation for big cap tech becomes a little bit easier, and we have to think about quality. It's more than large cap. It's really about quality firms, one of the big balance sheets and pricing power. Yeah,
we're looking at the 10-year yield right now. The chart is striking. Over the last 12 months, just climbing up almost to 3%, Seema. Yesterday, we heard Bank of America say they're going long the 10-year and expecting rates to finish off 2022 at 2.25%. What do you think about that?
Yeah, we're similarly in line to that. So we're thinking by the end of the year around 2.4%. We do think, look, inflation is extremely high, but we do think from here, within the next couple of months, unless there's a major upset within the supply chain dynamic, that we should see inflation starting to come down slightly. And then when you start to think that, look, if there is a chance of recession in the next couple of years, it's quite difficult to see US 10-year Treasury yields move sustainably above that 3% point.